Ever since the Fed began its fight against inflation in 2022, there has been some winners and plenty of losers. But one of the biggest losers in all of this has been the commercial real estate space. Hey everyone, it's Jonathan here, and let's discuss why commercial real estate is getting hit so hard, the biggest winners and losers in the space, and possible ways to make money from all of this. So let's get right into it. So really, for us to get a good understanding of what's going on, we really have to start from the beginning of COVID. And at the beginning of COVID, obviously we all know everything went on lockdown and a lot of people started to work from home. And that caused kind of two big things to happen in the real estate market. The first thing was people upsizing their homes, maybe building out offices in their house so they could work comfortably and kind of separate that space between living at home and working. We also started to see office vacancies move up, which makes sense if people aren't going into office. And not vacancies necessarily in the sense that employers weren't leasing out space, but just vacancies in terms of people actually going into the office and working out of there. So to avoid a complete economic meltdown due to the lockdowns, the Fed cut rates to zero, which helped keep the economy afloat during this time of lockdown. Generally speaking, when the Fed funds rate goes down, so does mortgage rates as well. And when mortgage rates go down in real estate, whether that's commercial real estate or residential real estate, prices generally tend to go up. So by the Fed cutting rates, this caused massive speculation to occur in the real estate market, both commercial and residential. And as people started to look for bigger spaces to live in, that also helped push up home prices as well, which caused not only home buyers but also investors in both the commercial and residential space to pay crazy prices for property. Now, when we fast forward to 2021, the Fed and the government did a great job of avoiding meltdown due to some of the monetary policy that the Fed enacted and some of the fiscal policy that was passed up in DC. But on the flip side of this, they did a little bit too good of a job, and we ended up having some of the highest inflation that we've had in over 40 years. Given how aggressive inflation is on society as a whole, especially lower income individuals, in 2022, the Fed started out on one of its most aggressive rate hike cycles in history, pushing the federal funds rate from zero that we're at in early 2022 all the way up to 5.25% that we're at in a matter of under 18 months, with the current plan of continuing to raise rates in the near future. So now, since we've kind of talked about the general umbrella of what's going on, let's actually get a little bit more specific about what's going on in the commercial space. So like I said earlier, when rates go down, prices go up. Well, when rates go up, generally speaking, prices come down. And I know this hasn't necessarily been true in the residential space, especially in 2023, but generally speaking with real estate, that is the case. Really what happened with residential real estate is that because we went from 2.5-3% mortgage rates all the way up to 6-7% mortgage rates, it caused this effect where people try to hang on to those low rate mortgages, which causes very low inventory in the market as a whole. So that's kind of what's going on in residential space. Now, the commercial space is a little bit different. So typically buyers of commercial real estate are usually not your everyday normal Joes walking around. They're not what would legally be called natural persons. They're usually legal persons like corporations. And usually these funds, they have billions of dollars of money to invest with. And these entities are usually rewarded on maximizing the return that they get on the money they invest. For them to get all the juice out of the lemon per se, they really have to look to leverage to boost their returns, whether they're investing in the stock market or they're investing in real estate. And with commercial real estate, you don't usually get those typical 15 or 30-year fixed rate, fully amortized mortgages. And what I mean by fully amortized is throughout the life of the loan, you not only pay off interest, but you also pay off the principal as well. Generally, what you're going to see in the commercial space is you usually see these loans that are anywhere from about 5 to 20 years long that might be amortized out for about 25 to 30 years. Because the loan period is shorter than 25 or 30 years, usually what happens is that at the end of the loan payment, you usually have a giant balloon payment that you have to make. Now, normally what happens a lot of times in the commercial space is that mortgage will just get refinanced and it'll basically just happen again and again until the property is completely paid off for. And this works out well if you're inside a market where from the beginning of one loan period to the beginning of the next loan period, the rates don't fluctuate very much or they go down. For the past 10 to 15 years, we've been generally inside a low interest rate environment. And most of these loans that were made with very low interest rates during this time. But now, because of what the Fed has done, it's caused these rates to go up almost 2-3x what they used to be. And that puts significant strain on the cash flow of these properties. And given that some of these properties were purchased in a low interest rate environment, like I said, interest rates low, prices high. So they bought it at these high prices where now they're in a situation where the cash flow might not make sense for them to continue to hold on to that property. But at the same time, they can't really sell it and get their money back because the valuations have fallen so much. So investors right now are kind of in this, are kind of stuck between these two different things. And that's leaving many of them just to go ahead and FedEx their keys back to the bank and pretty much just wipe their hands clean of the property. And that's exactly what we're starting to see happen in cities like San Francisco. Just recently, real estate investment trust Park Hotels and Resorts stopped making payments on 2 of their hotels that they own in San Francisco, with the plan to turn in the keys to the bank on these properties. And on top of that, the company that operates the iconic Westfield Mall in downtown San Francisco, which is actually a mall that I frequented a lot when I was younger, is also walking away from their property as well after they lost some anchor stores like Nordstrom. And mostly these stores left just due to the lack of foot traffic because of the high crime in San Francisco, homelessness, and just generally the work from home movement as well. When people were able to work from home, a lot of people left San Francisco for places that they deem to be safer or nicer to live in. This is also combined with the fact that about a third of the office spaces in San Francisco are currently vacant. So foot traffic is down significantly. And this isn't exclusive only to San Francisco as well. We're also starting to see something like this in New York. Even though New York is still thriving with tourism, they're struggling when it comes to their office spaces. And currently only about 50% of their office space is actually full, with a lot of employers favoring more newer buildings instead of the older buildings that do exist in Manhattan. And this is driving up the vacancy rate of these properties up to a record 23%, which hasn't really been seen in the city for a very long time. And we could talk about any major city, and we're starting to see the same trend over and over again, especially in the office space. And even COVID boom towns like Austin are still seeing their vacancy rate in office space start to surge. So even with all this pain in commercial real estate, there's still a lot of bright spots. And one of these bright spots are warehouses. During COVID, we got a significant pull forward of a lot of the growth of e-commerce that started well before the beginning of the pandemic. And even though from a business side, we're starting to see that trend slow down, there still is very high demand for warehouse spaces to be able to fulfill deliveries and things of that nature. And we're still seeing the vacancy rate of warehouses still sit at a very low 3.2% at the end of 2022. Another bright spot as well is multifamily apartments. And really multifamily apartments have kind of rid the ride of residential real estate as well, which makes sense because they're basically in the same category. And throughout 2022, we saw massive pressure on residential real estate due to the Fed's aggressive rate hikes. And those higher rates forced a lot of people who would be buyers out of the residential real estate market. And because everyone obviously needs somewhere to live, a lot of buyers had to start turning to renting. And that's really what has kept multifamily kind of upright throughout this whole rate hike cycle. And it's also a reason why we saw such upwards pressure on rents in 2022. Out of the most recent inflationary reports, we have seen that rents have made up a significant bulk of that inflation. And now as we fast forward to 2023, we are starting to see more rentals hit the market to absorb some of the demand, which is starting to cause the growth of rent prices to slow down. Even if we do start to see rents start to flatline or start to grow at a much slower rate, generally speaking, when rental prices go up, they almost never really come down. Because of the stickiness of rent inflation, a lot of these owners will probably be able to hang in there and continue to keep making their cash flow, even if they do have to refinance into a higher rate mortgage. With all of this information, you're probably thinking, okay, how do I make money from all of this? So there's a couple different routes you could go when it comes to investing. And I don't think what's going on in commercial real estate will really have a huge effect on the banking sector as a whole. One thing you have to realize is that a lot of the bigger banks out there don't really touch commercial real estate financing. And a lot of this is left to smaller community banks or regional banks for that matter. And historically, most banks try to work with borrowers, whether it's commercial borrowers or residential borrowers, mostly because the cost of a foreclosure is usually so high that it's much better that the bank actually just tries to keep you in the property, even if it means they have to give you concessions or have to modify your loan or something like that. And this is generally what we did see in the commercial space quite a bit during the 2008 collapse. We saw a lot of banks really try to lend a hand to these commercial borrowers and really try to just keep them afloat so they could be able to make their payments. And recently, federal regulators have asked banks to work with borrowers to determine alternatives other than foreclosure. So these may be short-term accommodations like deferred payments or partial payments for a certain time period, so then they can kind of make it through this, I guess you could call it almost Federal Reserve-induced economic winter. So if the banks do go this route of making loan modifications, this could have a significant impact on their balance sheets. But I don't know if it's going to be such a big impact that's actually going to cause some of these banks to fail. I know we could look at what happened with Silicon Valley Bank or First Republic Bank and see, well, you see what happened to those banks. Why couldn't it happen to another bank? And even though that's completely true, one of the things we have to remember about SVB and First Republic Bank is that both those banks were highly mismanaged. And, there could be other banks out there that are mismanaged, but we just have to remember that it was bad management that caused those banks to fail, not necessarily the weight of commercial real estate. So personally, I probably would just avoid banks. I don't really like to invest in banks, especially when the Federal Reserve is on the upwards climb of their rate hikes. If they were on the downwards climb and they were starting to cut rates, then maybe there's a case there. But for me, banks are just too confusing to try to understand their balance sheets and how they make money. And some of their filings are just very difficult. And, the saying goes, if you don't know about it, don't invest in it. So I am staying away from it. Now, when it comes to REITs or real estate investment trusts, I'm generally not the biggest fan of them for a whole multitude of reasons, mostly because you tend not to get the best returns compared to you just owning the real estate yourself. You tend not to get a lot of the tax benefits, and you're kind of forced to take an income from it, which is, again, along the lines of tax reasons. But you could make a case for maybe using them to play the market a bit. One of the ideals is that you could short office REITs. This could be a good way to take advantage of this pressure that is in commercial real estate. But I'm not the biggest fan of that route, mostly because a lot of these office space related REITs have already taken about a 40 to 60% hit in their valuations. And given how forward the market can be at times, I personally think that this lemon has kind of had all the juice squeezed out of it. Now, you could be on the flip side and actually go out and buy office REITs. This would probably mean that you believe that the return to work movement will grow stronger, and that more and more companies will require people to come into the office on a more regular basis. Personally, I'm not willing to make that bet. I think that COVID has made a permanent change in the way that we work, even if it means that we still see a majority of people maybe work off a hybrid schedule. So I don't necessarily believe that office real estate will charge back the way that some people do. Then you could also make the case of, well, maybe I should buy warehouse and multifamily REITs because they're holding up pretty well. For me, I can't really disagree with that. But at the same time, when it comes to real estate exposure, for me, I'd rather just go out and own the property. But unfortunately, I'm about a couple of tens of millions of dollars short to buy that level of commercial real estate. So I probably will not be participating in that. But if I did have that kind of money, that's probably the route I would go, would just be to actually just buy the buildings myself. So my overall take is that like I said earlier, I'm pretty bearish on that office spaces will come back. I think that work from home will continue to put pressure on office spaces. And I don't know if that trend's going to reverse very soon. I'm not really willing to gamble. When it comes to multifamily, I think that multifamily has been the king of commercial real estate for quite some time, pretty much ever since the 2008 housing crisis. And I think that it'll continue to be, even if we start to see growth start to slow down. As you can tell, I'm very bullish on residential real estate. And if you watch any of my other videos, you probably already know that. When it comes to warehouses, I see there will always be a need for them even after the pandemic, especially given how people have realized how efficient it is to be able to just order something off your phone and not have to go to a store or anything like that. So I think that warehouses are here to stay. When it comes to their growth, I think it'll be very cyclical depending on where we are with the economy and consumer spending. But overall, I'm not really excited to jump into any of these spaces. So I'm just going to really watch from the sideline and see kind of what takes place. So that's basically all I got for you guys. Thank you so much for watching. As always, please like, share, and subscribe. And I'll see you in the next video. Peace.